Good afternoon. My name is Robert Homans. I, along with Robert Teichman, are the managing partners and co-founders of Apereo Associates. Apereo Associates offers commercial finance workshops globally for commercial finance companies and individual professionals. The purpose of this workshop today is to get our potential clients and customers familiar with what Apereo Associates is, who we are, and our approach to the industry. Workshop number one is the first of 5 workshops that we offer, entitled Elements of Commercial Finance. The other 4 include credit and risk management, documentation and packaging, financing agricultural enterprises and food manufacturers, and financing equipment that's friendly to the environment. So with that brief introduction, let's get started. First, we have some definitions of the types of transactions we're going to be talking about today. We're also going to talk about principles of selling commercial finance transactions, focused on why your customer needs your product, how to explain the benefits of what you offer to a customer, and finally, developments of commercial finance products, basically what you're selling. First, we have some definitions of the types of transactions we're going to be talking about today. We're also going to talk about principles of selling commercial finance transactions, focused on why your customer needs your product, how to explain the benefits of what you offer to a customer, and finally, developments of commercial finance products, basically what you're selling. Commercial finance is very simple. It's financing for businesses. It's distinct from consumer finance. Commercial finance is often offered by financial institutions that specialize in commercial finance. Banks typically offer both business and consumer financing. You can often find commercial finance companies as bank subsidiaries, but it doesn't really matter. They're all doing the same thing, which is financing businesses. Commercial finance primarily consists of 3 types of obligations. Financial leasing and equipment loans both have terms greater than 12 months. They're called medium-term financing. And we'll get into the difference between the two in the next few slides. Working capital financing is usually 12 months or less. Working capital financing is, as it says, is financing working capital. What is working capital? Anybody know? Working capital basically is how businesses operate. Without working capital, a business cannot operate. It would only be a bunch of manufacturing equipment, a building, and that's it. There are 2 elements of working capital. One is current assets that include cash, accounts receivable, and inventory, and also current liabilities, which primarily include accounts payable. It can also include other types of current liabilities, but for purposes of this workshop and presentation, we'll focus on accounts payable. We'll start with types of leases. A finance lease is, as mentioned, the most common. Let's go down to the 3rd bullet point under finance lease. Everybody know what depreciation is? Let me define depreciation for you. Depreciation is a non-cash expense that can be deducted from a company's net income. Its purpose is to allow companies that acquire equipment to recover the cost of that equipment over a period of time. And the period of time depends on what type of asset it is and what type of how much depreciation is allowed. For example, in the case of computer equipment, depreciation can be 3 years. Most manufacturing equipment can be either 5 years or 7 years. Real property, buildings, and other types of real property can be 20 years. Depreciation is added to net income, and the total is your cash flow. And as we'll see throughout the course of this presentation, cash flow is a critical factor. In a finance lease, the title to the lease equipment passes to the lessee from the lessor at the end of the initial lease term. Just as if a lessee purchased equipment for cash, the lessee assumes the risk and benefits from using the equipment. The lessee pays for insurance, maintenance, and taxes that together is called a triple net lease. You'll see that term and hear that term a lot. A sale and leaseback is similar to a finance lease, but with some critical differences. First, the leased equipment starts out by belonging to the company, a company, which will eventually become the lessee. So how does that work? Well, the company needs working capital. They need some cash to acquire raw materials or hire some more people, so on. So a company finds a lessor and they sell the equipment to the lessor, and the lessor then leases the equipment back to the company. Now, practically the way that works is that the lessor and the company, now called the lessee, have to agree on an appraiser who will value the equipment for purposes of determining the initial value of a lease transaction. And usually that value is discounted by a certain amount, and that ends up being the initial price of the lease. A transaction in a sale and leaseback, as with a finance lease, involves the passage of title. And in the case of a sale and leaseback, that's done by a bill of sale. Whereas in a finance lease, it's done by the invoice, because the lessor is buying the equipment from an equipment supplier, and the equipment supplier provides the lessor with an invoice that shows the lessor as the sold to, and the lessee is the shipped to, and the shipped to is the lessee's physical place of business. Operating leases are very confusing and difficult to understand. But by the end of the next few slides, you'll have an intimate understanding of operating leases. A few years ago, I was working with the office of an international development bank located in a South Asian country. And they wanted banks in that country to start offering operating leases. They thought that was a very good idea. It's actually a lousy idea. And the reason it's a lousy idea is because in an operating lease, the lessor, which would be one of these banks, would have to share the risk with the lessee from operating and using the equipment. And banks, especially in a country like the one I was in, is just not set up to do that. I hope that I disabuse them of this idea of using operating leases, but I'm not sure. I gave it my best effort. But by the end of the next few slides, you will understand why it is a bad idea. However, there are advantages of operating leases to both lessee and lessor. To the lessee, there are lower monthly payments. And the reason why there are lower monthly payments is because an operating lease does not allow the lessor to recover the cost of the leased equipment in periodic payments. They have to take a risk in the sale of the equipment at the end of the lease term. So that's why the monthly payments can tend to be lower in an operating lease. Operating leases are therefore often used to finance equipment that holds its value and sometimes even increases in value. Those examples include transportation equipment like aircraft, locomotives, train carriages, and so on, and also construction equipment. And also, I forgot, title vehicles, cars, trucks. Those types of assets either hold their value, or in the case of title vehicles, they have publicly available information on what the resale value is over the term of the lease. Operating leases can address equipment obsolescence because a lessee, once the lease is over, he can simply give the equipment back to the lessor and then turn around and lease some newer equipment. In some cases now, but in decreasing number of cases, a lessee can account for an operating lease not on the balance sheet as a liability, but in the footnotes to a financial statement. And what that does is, if the company has bank loans almost always come with covenants, and covenants require that the borrower maintain certain financial ratios and income, both in the income statement and the balance sheet. If you're including operating lease obligations as a liability, it makes complying with those covenants that much more difficult. Currently, operating leases are unregulated in many markets. As far as the lessor is concerned, they have to worry about the resale value of the equipment. If the resale value goes down for, let's say they come up with a new model of a 737, or there's some problem with the plane, as there has been lately, the resale value can change, and they're going to lose money, the lessor. There's also technological obsolescence. There was a company called ITEL, I-T-E-L Corporation, that existed in the 1970s, and what they were doing was financing mid-frame computers under operating leases. Mid-frame computers are somewhere in between a mainframe, which takes up an entire room or maybe even a floor of a building, and a desktop. But guess what? In 1980, IBM came up with the laptop, and a lot of those mid-range computers lost all of their value, and ITEL had to file bankruptcy. ITEL used to be a very popular place for classmates of mine at Stanford Business School to find a job, because as we're going to see, operating leases require a certain amount of negotiation and pricing and all of that sort of thing. And MBAs love those types of companies. But unfortunately, they all lost their jobs when the ITEL went bankrupt. There's also the risk of regulations. And I think the major risk of regulations in many markets is markets that have leasing laws. And leasing laws are usually found in countries that follow civil law, civil code. because under the civil code you have all sorts of requirements. You can only do what is written down. And right now, leasing laws, at least the ones I'm familiar with, only apply to finance leases. But if somebody comes along, and I'm sure they will come along, that wants to include an operating lease in a leasing law, it's going to be a disaster, because, as you can see, there are all types of variables in putting together an operating lease, and they can't possibly be included in a leasing law. Pricing and structuring of operating leases must conform to all of the following 4 criteria. And these are all included in something called US FASB 13, FASB 13. And FASB 13 has been embraced in many other leasing markets. So the first criterion is an operating lease does not automatically transfer ownership of the leased asset to the lessee at the end of the initial lease term. It goes back to the lessor unless there's an agreement between the lessee and the lessor to purchase the equipment, and the purchase price has to be fair market value. You know, what a willing seller would sell to a willing buyer, and it's otherwise known as an arm's length transaction. And that leads me to the second criterion, which where an operating lease cannot contain a bargain purchase option. Purchase options have to be consistent with fair market value. So you can't find an operating lease that contains a purchase option for $1 or $100 or 10% of the original purchase price of the equipment. That's not allowed. Operating lease term has to be less than 75% of the estimated economic life of the leased property. In other words, the tax depreciation of that property. And so if you have a leased piece of leased equipment has 5-year depreciable life, you can't have a lease term that's greater than 44 months. And again, what that does is it forces the lessor to take an equipment risk because it shortens the term. And finally, the most difficult criterion of that need to be complied with is the present value of the minimum lease payments. Minimum lease payments are the actual lease payments. Has to be less than 90% of the fair value of the leased equipment at least inception. And that's an important term that we'll go back to in a minute. It's not exactly as it sounds. What is a present value? Everybody know what a present value is? It's the value today of a series of payments coming in the future. And the way that present value is derived is through use of normally a discount rate. In this particular example, it could be the incremental borrowing rate of the lessee, if the lessee has a bank loan, for instance. Or it could be, if they don't have a bank loan, it could be the incremental borrowing rate of one of their competitors, if you can find that information. Or it could be the yield on public debt, maybe marked up by a certain amount. Yield on a treasury bond, for example. So to close this, if a lease does not conform to all 4 criteria, it is a financial lease. So how does a lessor comply with the 90% rule and have their lease transaction be considered a operating lease? Okay, let's start here again. So how in the world does a leasing company comply with the 90% rule? Here's some ways that they might be able to do that. they can take a larger residual. So the assumed value at the end of the lease term goes up, lease payments go down, and the 90% rule is met. Second, you can take a refundable security deposit that's not a minimal lease payment, and that security deposit can be handled in different ways so that you can comply with the 90% rule. You can also create contingent rents, and let me kind of explain how that might work. You're financing an aircraft or a locomotive or a vehicle, and you have a provision in the lease agreement that the lessee can only use the aircraft a certain number of hours. But every month the lessee exceeds those hours, and every month it creates a contingent rent. But the contingent rent is not included as a minimal lease payment. So effectively, you're increasing your yield. You can also raise the discount rate, because again, if the discount rate will lower the present value of the minimum lease payments. But it has to be defensible. And if the discount rate is out of proportion to what exists in the market, your accountant or somebody or a regulator or somebody is going to say that your transaction is not an operating lease. You can also go for a shorter term. And with a shorter term, you have fewer payments, and that way you can also comply with the 90% rule. You can also have early termination penalties. So if a lessee terminates the transaction early, the termination penalty becomes due and payable, but it's not considered it's not considered a minimum lease payment. So that's another way you can do it. All of these could be contained in side letters. Side letter means it's a document that's not part of the actual agreement. You can also go to the vendor and get what's called a blind discount. And the way that works is if you have a piece of equipment costing $100,000, the vendor gives you a 10% discount, but which would lower your payments. But you also you show the value of the equipment at the beginning of the lease at $100,000. And just for a second, let's go back to a previous slide and look at the wording here. The fair value of leased equipment at lease inception. If you think about what that means, the fair value of the leased equipment is actually $100,000. The vendor might give you a discount, but you can still use $100,000 as your fair value, but have the lease payments reflect the fact that you got a 10% discount. You can also recharacterize items considered in minimum lease payments. An example might be if you're leasing a fleet of vehicles, delivery trucks, for instance, and you have a management fee built into the lease payments. You can take part of that take the management fee out of the lease payments and treat it separately, and that way you can meet the 90% rule. Number 10 is related to that. You break out executory costs, legal costs, documentation fees, and so on. You break those out from the minimum lease payments, and that would also help you meet the 90% rule. Future developments in operating leases would includes the merger of generally accepted accounting principles in the U.S. and international financial reporting standards in the rest of the world. The practical effect of that it is going to make it difficult to even use operating leases, and certainly um, it will change. It will limit the accounting disclosures. It's going to be more difficult to include operating leases only as a footnote and keep them off the balance sheet. An example of an industry that could be very adversely affected by this are retailers, companies that have like a chain of retail stores, and they all of the leases that they use to lease their retail premises are operating leases. If those have to be disclosed as liabilities on the financial statements, it's going to make dealing with banks more difficult, especially because of the covenants. So we'll have to see how that works out. But it's something that if you're dealing in the retail industry, that is something to keep in mind. It also, some of the new rules are going to require placing value on items such as contingent rents, which also could make compliance with the 90% rule more difficult. What is an equipment loan? We mentioned earlier that the borrower owns the equipment, not the lessee. And the borrower purchases the equipment from an equipment supplier. There's no transfer of title. The lender retains a security interest in the equipment, but not ownership. So they register a security interest in a movable asset registry and not ownership. Payments can be identical to a finance lease. There's really no difference. What makes a finance lease an equipment loan? Once again, as we said earlier, the payments are often the same. The accounting treatment is usually the same. Disclosures are increasingly the same. So why would somebody want to do one or the other? I have had a customer that was financing a active solar array to generate electricity. And he was going to get a very large rebate from the state where he was located. But if he did a financial lease, the owner of the equipment would be the lessor, and the owner gets a rebate. So he didn't want that. So we did an equipment loan precisely because that way he'd be shown as the owner and would get the rebate. Finally, working capital financing. It's also often called supply chain financing. I personally don't like that term because there are a lot of companies that are engaged in that are parts of various supply chains that might need leasing or equipment loans, which is different from working capital financing. So a better term is working capital financing. And you can talk about supply chain financing, you can talk about in a way similar to commercial financing. So there are 4 different obligations that are included in working capital financing. The first and most common is lending against accounts receivable. You're a company that is a manufacturer, and you produce something that you sell for $100,000, and you give your customer 30 days to pay you back. You've created an accounts receivable, and you can take that receivable and go to a finance company and borrow against it. And what a finance company typically does in that process is they'll check the credit of the seller and the buyer. So there's 2 credit decisions involved, not just one. And then they will make a determination. Usually they'll provide what's called an advance. It was equal to the percentage of the amount of the receivable, and that would be the amount of the loan. And normally you have 30 days to repay, which is the same credit that you gave to your customer. factoring is basically the same, except that in the case of factoring, you're selling an accounts receivable to a finance company, and that finance company is called a factor. But the credit process and the determination of the amount of the proceeds from the sale of the receivable are pretty much the same as lending against accounts receivable. Inventory financing is lending against, as the name suggests, lending against the value of inventory. And typically the way that works is you bring in an appraiser, as you would with a sale and leaseback. Both parties, the company and the finance company, jointly selects an appraiser, and the appraiser looks at the inventory and gives a value to it, and then the lender normally lends against the value of the inventory based on a percentage of the value. So it's again a similar types of mechanics to accounts receivable. The last one is the least common. It's called margin lending, and margin lending is a loan against the value of marketable securities and maybe on a company's financial statement as a current asset. And it mostly involves marketable securities like shares of stock that are listed on a public exchange. There's only one problem with this. Most finance companies do not have a securities license, and a securities license in most markets is required to do margin lending. Now, as some of you know, interest rates on working capital financing, for example, lending against accounts receivable, can be very expensive, 36%, let's say. So why on earth would any company want to borrow an amount where the interest rate is 36% per year? Well, here's why. Going back to our original example, you have a receivable of $100,000 due in 30 days. And sometimes companies, the seller will tell the buyer, look, if you pay within 10 days, I'll give you a 2% discount. That is called 2% 10 net 30. 2% if you pay within 10 days, and you have 30 days to pay the entire amount. Okay, so basically you, as a seller, you are telling the buyer that the buyer's money is worth over 36% a year to you. That's the basis for a 2% discount. And so you get the buyer's money back within 10 days, and you can probably turn that around and use that money in your own business at a return of 50%. Okay, so if you can do that, then borrowing money to get, borrowing money at 36% makes sense, because you got a spread of 14% on that borrowing, 36 versus 50. And that's why finance companies are in business. And once again, leasing and equipment loans and working capital financing have one thing in common, and that is they help businesses with their cash balances, improve their cash positions. Leasing and equipment loans do it because it allows a company to use use revenue generating equipment without having to pay cash for the equipment, and thereby tying cash up in a piece of equipment where likely the return is much less than the 50% you're getting to keeping the cash in active in your business. So that's the benefit, the primary benefit of leasing and equipment loans. And so we are very strong believers in commercial finance products. And what is a commercial finance product? It describes product limitations. You can have an industry focus. Like, for example, in my business, I lease almost nothing except equipment for food manufacturers and manufacturers of personal care products, pharmaceuticals, nutritional supplements, beauty products, and so on. I understand why these companies need leasing, and basically it's because they have huge working capital requirements. They're always buying raw materials. They're buying packaging. They're probably hiring more people, and so they don't want to tie up their cash. So they come to me and I lease them equipment. Another example of this is in the retail industry. I have a customer that manufactures various types of marinades, and one of their major customers is Costco. Costco is a big one of these big retailers, and Costco said to them, "Look, we will put your product at the end of a store shelf, right in the aisle, so people can see it, and you'll be able to sell more of your product that way. But in return, we want 60-day terms." So they're having to tie up their cash for 60 days until Costco pays them. So what do? They go to a working capital. They go to a finance company and lend against that receivable. You know, Costco is a Fortune 500 company, a big company, and their credit is good, so they can probably get very good terms from that. You can also have products based on transaction size. We'll see later on that in the case studies that we've included in this workshop, you can have transactions for under $50,000 where you have limited financial information required, and transactions over $50,000 which requires more financial information up to and including financial statements. You can also have products based on types of equipment. The best example I can provide here is companies that lease automobiles. I don't know if the first thing about leasing automobiles, and I would never be silly enough to compete against companies that do. Lease products include all terms and conditions, credit requirements, documentation requirements, term structure. Term structure includes the length of time of a transaction. You could have a 60-month lease or a 36-month lease. It also includes different types of payments. If you're leasing to a farming operation, for example, you can offer them seasonal payments, which reduces the payment size when a farming operation has their crops in the ground and is incurring a lot of cost prior to the harvest. You can also have what's called step payments. Let's say a lessee is introducing a new product, and they finance some equipment that they use to produce that new product, but the revenues from the product sales start building up. They don't instantly they're not instantly making huge amounts of sales. So you set up something called step payments, where the payments start out low and then go up to reflect the sales growth that they're expecting. And again, we're going to be using a lot of case studies to illustrate this. So what do you do? So what are the things that you need to think about when you're selling a product? There are really just two important principles that you have to follow. The first is you have to, as a loan officer, you have to understand the economic benefits of the transaction that you are proposing to the customer, and be able to explain it clearly. And one of the benefits for these workshops is we're going to show you how to do that. The second principle is all commercial finance transactions. It doesn't matter if it's a lease, equipment loan, or a working capital financing. They're all money over money propositions, which is defined as that the economic benefits are greater than the associated payments. So in the case of a financial lease or an equipment loan, the benefits, which usually are increased revenues, lower costs, and hopefully both at the same time from using a piece of equipment, exceed the payments, whether they're loan payments or lease payments. In working capital financing, as we discussed a minute ago, the benefit is the early use of proceeds from a credit sale. And as we discussed, the return on cash in the business is quite high. And so working capital financing helps you attain that. And keep in mind, and this is probably the most important thing you'll learn on this slide, there is no direct reference to an interest rate. If you get into the point of discussing interest rates with your product, I can virtually guarantee you that you're not going to be able to sell that product, because you're going to be haggling with the customer. Well, what's the interest rate? And well, so and so down the street is offering a lower rate, and so on, and it just will get you nowhere. So try to do your best to deflect any type of discussion on interest rates. As a friend of mine once pointed out, there are three important things in financing. There is availability, there is term structure, and there is price in descending order of importance. So if you don't have availability, then interest rates don't matter. If you don't have acceptable term structure, interest rates also don't matter. So those are really the two things that are far more important than the cost. And so here are some general examples of working capital finance products, and we will get into details later in workshop number 1, provided that you come to us and are interested enough to buy the entire workshop. Typical product for leasing and equipment loan can be broken down between small transactions, might include office equipment, small manufacturing equipment, and you require limited financial information. Larger transactions, maybe more than $50,000 involving manufacturing equipment. Those are referred to, and we'll get this. We'll get to this term in a minute. They're referred as cash flow leasing. And most larger transactions require more financial information, financial statements and other things. And then in the case of working capital financing, quite often the major beneficiaries are small companies, like a small manufacturer, for example, who is starting production. In order to get the sale done, they have to offer terms to the buyer, but at the same time, they need the money from the sale, so they will go to a finance company. Another example would be a service provider. A good friend of mine has a little finance company, and some of their major a little receivables lending company, and one of their customers provides uniforms to companies where uniforms are required by the company, and so they provide uniforms to the employees. The employees use the uniforms for a day or two. They give them back. They're put in the washing machine and the dryer, and the service provider provides new uniforms. And there's a lot of instances in this industry where you have to offer credit terms to customers. Okay, we talked about cash flow leasing. What is cash flow leasing? You normally see cash flow leasing become important on larger transactions, maybe over $50,000. And the credit approval is based on the lessee's historical ability to repay. And in order to do that, you need financial statements. You can't, like in smaller lease transactions, you can't rely on things like bank references, or if you're located in Kenya, there are a company's M-Pesa statements, which shows money going through the business. You have to have financial statements. And for us in the leasing business, for credit approval purposes, we often assume that the value of the leased equipment is zero. Now, just sort of let that sink in for a minute. So we really don't care about what the equipment is as long as the cash flow works. And we're assuming that during the lease term, if we have to repossess that equipment, that basically we're not going to get any money at all in a repossession. So we're relying almost totally on the cash flow of the lessee. And unfortunately, in many emerging markets, cash flow leasing is almost non-existent. And until it starts growing, until there's more cash flow leasing, you're not going to see, in our opinion, you're not going to see the kind of growth in leasing that markets like this really need. And like, for example, I'll give you two examples. There's a company in a country that I know of, or a leasing company in a country that I know of, that relies almost totally on the resale value of the asset. They're not looking at so much at the company's cash flow. If they have to, their primary security is the resale value of the equipment, whereas in our case, the resale value is zero. So what does that say? I mean, you're not going to you're not going to be able to to realize anything unless you sell equipment. And if you sell the equipment, how's your lessee going to make any money? So that doesn't make any sense to me. There are other markets that, and this is something that's really the fault of regulators. They're requiring that the lessee come up with collateral equal to over 100% of the leased amount. How many small businesses in a sub-Saharan African country have that kind of collateral? Almost none. And so the result is you don't do very much. You don't do a great deal of volume in leasing business. Until that changes, the growth in many of these markets in leasing is going to be minimal. And so we have to, as a industry, I think, we have to intervene with the regulators and show how cash flow leasing not only makes sense, but also makes sense from a risk and credit standpoint. And once again, the workshops that we offer are listed here. They start with general, the first three, and then they go to specific markets, manufacturing of financing agricultural and food manufacturing equipment, or financing equipment that's friendly to the climate. One example of that is the solar array that I mentioned earlier. We also offer advisory services, how to incorporate commercial finance products into your business, into your operations. We develop policies and procedures manuals that govern the operations of a commercial finance company. And we also work with regulators on the very types of issues I mentioned a minute ago. Usually we do the latter in conjunction with development banks who, as we are interested in expanding leasing volume in a certain market. So that's really essentially what we do. We look forward to hearing from you, and please contact us at info@aperioassociates.com or by telephone. And thank you very much for your attention, and we look forward to further discussions on how we might be of service.